Hey everyone, welcome back to Corporate Decoder, where we peel back the layers of big business filings to find the real story. Today we're diving into what Goldman Sachs told us in their latest quarterly report, and let me tell you, the numbers are singing a mixed tune, some sweet, some a bit sour, before we jump in. If you like getting the inside scoop on financial documents like this, make sure you hit that subscribe button. And if you want to chat more about these filings and get exclusive insights, join our Discord community linked in the description below. The 30th of September 2025. That is the date we're looking at, the end of the third quarter for Goldman Sachs. Okay, let's talk about the big picture. Goldman Sachs, or as they call themselves, the Group Incorporated is a huge financial outfit, a global player with offices everywhere aiming to offer all sorts of financial services. They make their money from a bunch of different areas. Think investment banking, where they help companies merge or go public, investment management, where they handle money for clients, market making, where they sort of facilitate trades and other principal transactions. Now, for the juicy part, the financials for the third quarter of 2025, Goldman Sachs brought in a cool $15.18 billion in net revenues. That is a solid jump of 20% compared to the same time last year. A big chunk of that came from investment banking, showing $2.66 billion, a hefty 43% increase. This means companies were busy with mergers and acquisitions and raising money through debt. And get this, net interest income was up a massive 64%, hitting $3.85 billion for the quarter. That tells us something about their lending and borrowing activities, likely benefiting from higher interest rates. All this activity translated into strong net earnings of $4.1 billion for the quarter, a significant jump from $2.99 billion the previous year. That's a good sign for shareholders. Looking at the balance sheet as of September 2025, their total assets are sitting at a staggering $1.8 trillion. That is a pretty big number, up from $1.67 trillion at the end of 2024. A lot of that increase is in their trading assets and loans, showing they're busy in those areas. On the other side, their liabilities also went up, mainly in deposits and borrowings. Shareholders' equity is also up to $124.4 billion, which is great for stability. It shows a healthy chunk of the company is owned by its shareholders. Now, when we dig into what is driving the numbers, particularly in those complex areas like trading, we see some interesting things. Their trading assets, which are basically investments they make to profit from market movements, are quite large, over $652 billion. A significant portion, over $21 billion, is classified as level 3. This means it relies on unobservable inputs, so it is harder to pin down its exact value. Derivatives, those complex contracts whose value depends on underlying assets, also show substantial amounts. While most of it is in level 2, meaning observable inputs help determine its value, there is still a chunk in level 3, over $5.6 billion in assets. Digging into the loans section, we see a lot of real estate exposure, both commercial and residential. These are significant numbers reflecting a big part of their business. This also means they are sensitive to the housing market. When we look at the risks, especially with credit derivatives, we see that things like credit spreads and option volatilities can really move the needle. These are like the hidden factors that can swing the value of these complex financial products, and they also fall into that level 3 category, meaning they often rely on unobservable inputs. The report mentions sensitivity to things like correlation and volatility, which are fancy ways of saying how interconnected the market is and how much prices tend to jump around. Good news on the credit loss front for the most recent quarter. They actually saw a slight decrease in the provision for credit losses, which is the money they set aside for potential loan defaults. This suggests they might be seeing some stability or even improvement in the credit quality of their borrowers compared to last year. But it wasn't all smooth sailing. Operating expenses went up by 14% for the quarter, a big chunk of that being compensation and benefits. This is understandable given better financial performance, but it is worth keeping an eye on how much of their revenue goes to paying people. Specifically, compensation and benefits expenses saw a substantial increase. This is often tied to the company's success, so it is not necessarily a bad sign, but it does eat into profit margins. Despite the higher expenses, net earnings applicable to common shareholders saw a healthy increase, going from $2.78 billion to $3.86 billion. That is a very positive trend for the investors. They've also got a huge amount of lending commitments out there, over $319 billion in commercial lending alone as of September. That is money they've promised to lend, and it is a big responsibility if the market turns south. Looking at the overall direction, Goldman Sachs seems to be navigating a complex market fairly well. Their investment banking and asset management arms are performing strongly, boosting revenues. However, the market-making businesses, while still substantial, saw a slight dip. And some of those level 3 assets and derivatives carry inherent uncertainties due to their reliance on unobservable inputs. On the tax front, their effective tax rate is hovering around 21.5%, which is pretty standard for a big financial firm. They are also keeping a close watch on global tax rule changes, but currently it doesn't seem to be a major headache. And finally, no discussion of an SEC filing is complete without mentioning the auditors. PricewaterhouseCoopers LLP reviewed their interim financial statements and gave them a clean bill of health, stating they were not aware of any material modifications needed for conformity with US GAAP. What does all this mean for Goldman Sachs? They're showing resilience in a tough economic climate with strong performance in key areas like investment banking and solid capital ratios. However, their heavy reliance on complex financial instruments and market-making activities means they're always walking a tightrope. The significant chunk of level 3 assets and the inherent risks of derivatives require constant vigilance. The increase in operating expenses, particularly compensation, is something to monitor, especially if revenue growth were to slow. Overall, Goldman Sachs appears to be navigating the current environment with a blend of strength and caution. They are benefiting from deal volumes and solid market activity, but the underlying complexities of their business mean that any significant market downturn could present challenges. Now, looking at these results more broadly, Goldman Sachs appears to be managing its current position reasonably well given global economic uncertainties their core businesses are performing, and capital levels are strong. However, the sheer scale and complexity of their trading and derivatives operations, coupled with those level 3 assets, means to raise always a lurking potential for volatility. The increasing cost of compensation is a trend many companies are facing, and how they manage that efficiently will be key. What is your take on these results? Do you think Goldman Sachs is well positioned for the future, or are there underlying risks investors should be more concerned about? Drop your thoughts in the comments below. If you found this breakdown valuable, hitting that like button really helps us out, and of course subscribe so you don't miss our next corporate deep dive. And hey, if you want to dive deeper into these filings and connect with other finance enthusiasts, come join our Discord community. The link is in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.